Long-term investment strategies. A deep dive. Long-term investing is a proven strategy for building wealth, minimizing risk, and ensuring financial security. Unlike short-term trading, which focuses on quick profits, long-term investing involves holding assets for years or even decades to take advantage of compounding growth and market appreciation. This guide will explore the key long-term investment strategies, how to build a diversified portfolio, and the best ways to ensure financial success over time. 1. Why long-term investing works. Long-term investing is based on the principle that markets tend to grow over time despite short-term volatility. The stock market has historically delivered an average return of 7 to 10% per year when adjusted for inflation. Here's why this approach is effective. Compounding growth. Compounding means earning returns on both your initial investment and the returns it has already generated. The longer you stay invested, the greater the compounding effect. Example, if you invest $10,000 and earn a 10% return per year, after 30 years, your investment grows to $174,494, even if you never add more money. Market volatility and recovery. Markets go through cycles of ups and downs, but history shows that they recover over time. Investors who panic and sell during downturns often miss out on market recoveries. Example, after the 2008 financial crisis, the S&P 500 dropped more than 50% but fully recovered and reached record highs within a few years. Lower taxes and costs. Long-term capital gains taxes are lower than short-term trading taxes. Buying and holding investments reduces the need for frequent trading, lowering brokerage fees and transaction costs. 2. Key long-term investment strategies. Here are some of the best long-term investment strategies that help grow wealth steadily. Buy and hold strategy. The simplest and most effective strategy involves buying high-quality assets, stocks, real estate, bonds, and holding them for years or decades. Example, investing in the S&P 500 index in 1990 and holding it until today would yield massive returns. Diversification strategy. Spreading investments across different asset classes reduces risk. A balanced portfolio might include stocks, growth and dividend, bonds, for stability, real estate, for passive income, commodities, gold, silver, crypto for inflation hedge. Example, if stocks crash, other assets like bonds and real estate can help stabilize your portfolio. Dividend growth. Investing focuses on companies that consistently pay and increase dividends. Provides passive income while also growing capital over time. Example, investing in companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble that have increased dividends for decades. Index fund investing. Instead of picking individual stocks, invest in a broad market index fund, like the S&P 500 or NASDAQ 100. Index funds offer low-cost diversification and have outperformed most actively managed funds over the long term. Example, the Vanguard S&P 500 Index Fund, VOO, has provided an average return of 10% per year over several decades. Real estate investing. Buying rental properties or real estate investment trusts, REITs, can generate passive income and capital appreciation. Unlike stocks, real estate provides tangible assets and inflation protection. Example, buying a rental property that appreciates in value while earning rental income every month. Dollar cost averaging, DCA. Instead of investing a lump sum, invest a fixed amount regularly, for example, $500 per month. This reduces the risk of market timing and ensures you buy assets at different price levels. Example, investing $500 in an S&P 500 fund every month for 30 years can lead to millions in retirement savings. Tax-efficient investing. Using tax-advantaged accounts like 401k, IRA, Roth IRA, and HSA helps grow investments faster by minimizing taxes. Holding assets for more than 1 year reduces capital gains tax rates. Example, investing in a Roth IRA allows tax-free withdrawals in retirement. 3. Building a long-term investment portfolio. A well-balanced portfolio ensures growth, stability, and risk management. Here's how to allocate investments for long-term success. Growth-oriented portfolio. Aggressive 80% stocks, 10% bonds, 10% real estate, crypto. Best for young investors looking for high long-term growth. Balanced portfolio. Moderate risk, 60% stocks, 30% bonds, 10% real estate. Best for investors in their 40s, 50s who want growth with stability. Conservative portfolio. Low risk, 40% stocks, 50% bonds, 10% real estate. Ideal for retirees or those who want low risk and stable income. 4. Avoiding common investment mistakes. Long-term investing is simple, but many investors make costly mistakes. Here's what to avoid. Emotional investing selling during a market crash leads to locking in losses. Instead, stay invested and trust the long-term growth trend. Trying to time the market, no one can predict market highs and lows consistently. The best strategy is to invest consistently rather than waiting for the perfect moment. Ignoring fees and taxes, high mutual fund fees and frequent trading can erode returns. Choose low-cost index funds and use tax-advantaged accounts whenever possible. Not rebalancing your portfolio over time, assets shift in value. Example, if stocks grow faster than bonds, you might have too much exposure to risk. Rebalancing once a year ensures your portfolio stays aligned with your goals. 5. The role of long-term investing in early retirement. Many people use long-term investing to achieve financial independence and retire early, FIRE. Here's how. The 4% rule: if you withdraw 4% of your portfolio per year, your money should last 30+ years. To retire early, you need 25 times your annual expenses invested. Example, if you spend $40,000 per year, you need $1 million in investments to retire. Income-producing assets, dividend stocks, rental properties, and REITs provide passive income, reducing reliance on portfolio withdrawals. A well-structured portfolio can generate enough income to cover expenses indefinitely. Cutting expenses and increasing savings rate: the more you save and invest early, the sooner you reach financial freedom. A high savings rate, 50% or more of income, accelerates wealth building. Final thoughts: why long-term investing is the best wealth building strategy. Time in the market beats timing the market. The longer you stay invested, the better your returns. Diversification reduces risk and enhances stability. Compounding growth turns small investments into massive wealth over decades. Tax-advantaged accounts, 401k, IRA, Roth IRA, help maximize long-term returns. By sticking to a disciplined investment strategy, you can build wealth, secure financial independence, and even retire early. Start today, stay consistent, and watch your money grow over time. Embrace the journey, ignite your passions, and join us as we explore the extraordinary together. Please like the video and turn on notifications for future uploads. I do not provide personal or financial investment advice, and I am not a qualified licensed investment advisor. This video's educational purpose is only to give you the basic idea. If you need a personal or financial advisor, please seek help. Thank you.